All right, ladies and gents, we're back. So we just looked at some of the liquidity ratios, ratios that tells you about the organization's ability to produce cash needed in the short term to cover its liabilities and obligations. And now we're going to look at activity ratios, your operating type ratios, where you look at the good use of your inventory and your accounts. The accounts receivable turnover simply gives an idea of how well the organization has been in collecting its receivables based on the credit sales, um, and it usually would give some credibility to your asset test ratios or your quick ratios. You want to be able to collect your accounts receivables in a short time period and within quick time. You don't want to have those things outstanding for too long. Now, 60 days, and in slide number 9, 60 days is usually the industry average. You would see on some large organizations, they would give 60-day credit terms to their customers. So 60 days is a good industry average, and that's the amount of time it takes to collect your receivable. Inventory turnover, sorry, your cost of goods sold minus over your average inventory, and your average inventory is the average of your beginning inventory and your ending inventory. Add the both, and you divide them into two, and you get your average inventory. The higher turnover in general means better performance. Inventory turnover, you're selling, you're continuously selling. Inventory turnover in days, so that's the number of days required to sell inventory. And this may come into play, for example, if you are in the process of completely having to close down. If you have to close down, you can get an idea. You can get an idea how much days it will take to actually sell out all your stock, so that you can have an idea to plan. Operating cycle is the sum of your operate accounts receivable turnover in days and your inventory turnover in days. And that tells you the number of days required between the acquisition of inventory and the actual realization of cash from that inventory, from it being sold and receiving the cash from it. Right? Your working capital turnover tells you how effectively your money is being used to produce the type of sales. You see, it's the sales over the working capital. And remember, all of this information that we are using in these different formulae comes from the different financial statements, your income statement, your balance sheet, even your cash flow as well. And then we go on to your profitability ratios. Now, this is where the bottom line comes in. This is where the executives would be looking at closely your return on total assets, your return on investments. So the first one there compares your net income with your total assets. Your gross margin and gross percentage, especially for those guys in community, this is something that's important. Your gross margin is your sales minus your cost of goods sold, and your gross margin percentage is your gross margin that you just calculated over your sales. So it's something that tells you how profitability your company on a very, very basic level. Higher gross margins, of course, you always hear organizations and financial executives talk about margin, and gross margin percent to give an idea of how much money is left over to be able to increase or improve on the business size and improve on investments. Again, I would draw you again to the show Shark Tank, and you would hear them talk about margins all the time. They always want the cost of producing an item to be as small as you can, and how much you sell it for to be the best that you can get it sold for based on the market. And that's what you call your margin. That difference between how much it costs and how much is actually sold is your margin. All right, and your margin percent is the ratio of the gross margin and your sales. Net profit margin, net income over your net sales. Operating margin, operating income over total sales. All right, and you see there in the bottom of the slide, a healthy operating margin is required for a company to be able to pay its fixed costs such as interest and debt. So your operating margin is an important margin. Asset turnover, net sales over total assets, and there's one called the dew point return on assets, which compares your profit margin and your asset turnover. Return on investment, complicated one. So return on investment is the ROI. You would hear people ask about it. Is the performance of the organization without regard to the type of financing that is used. So you want to know how well the organization is doing, how well it's giving returns on the investments that are given. This would definitely be a topic of discussion for when companies have shareholders meetings. When companies have shareholder meetings, this is something that is asked for explanation by the CEO or by the CFO. Return on common equity, or debt equity ratio. This again looks at the degree of protection to creditors in terms of insolvency. And you can see here when compared to year one, year two, the ratio is actually improving. So you want this ratio to be less than 1. So you would know that most of your liabilities are not because of your debts. Then we have the debt ratio. This is your long-term debt paying ability ratio times interest earned. Right, on slide number 26, your operating cash ratio. This looks at the company's ability to have sufficient cash for daily operations, whether it is generating enough cash to cover its current liabilities. If the ratio falls below 1, then the company is not generating enough cash to meet its commitments. And this is something very, very important. And a lot of companies right now would be having to look at this ratio to determine how well they are doing based on the given situation. And I don't know if some of you all would have seen about, anybody saw the news about Movie Town? Did anyone see the news about Movie Town? Yep, Movie Town is actually, well, we know from last week they closed on the show. Yes, but what I saw just last night, they were actually considering not reopening any of their branches, none at all, because they are saying that if we are now being asked to operate at 50%, and how much does it cost to operate? How much does it cost to operate versus how much revenue you're going to be generating? So they are actually in discussions with. We're going to be in discussions with IMAX and with South Park Cinema 10, Cinema 8, Caribbean Cinema, sorry, Caribbean Cinemas, so that as an industry, they can now come to a decision on if they're going to remain completely closed, because the cost to operate, when you compare that to how much revenues you're making, it may not make sense. All right. So they need these cinema based companies need to have cinemas make their money on the concession. So that, yes, so that's one of these suggestions that's been put forward, um, to be able to generate more revenue. So someone goes in, they buy a movie ticket, and then they would buy some food, and they would buy some drinks, some snacks, and then you go to the movie. So your total package, that's just for one individual, maybe just about $100. So now you're asking the movie operators to now have 50% of the persons coming in. So you don't even have a full theater. And then on top of that, you are not allowing them to have any food or drink at all. The reality is that these are the types of industries that would feel the effects of this pandemic and its restrictions, most heavily, just as the airline industry. And it is important that the authorities and the powers that be can come up with innovative solutions, for these problems. I can't see how much of a solution we can have, because we are looking at an entire large closed room with several people in it. Although they may be spaced out, the air circulation is an issue. The constant air circulation is an issue, and we are saying we know that if it is we have things being done in open air, that they you have it's preferred. It's less likely to now have someone who may be positive to um, to be able to transmit this to someone. But what can be? Tell me, guys. Tell me, guys, what can be a game changer for industries such as the airline industry, such as the cinema industry, such as the restaurant industry, that involve persons, one, being in an enclosed area, and two, having to remove your mask to participate in the business ventures, which is eating food or drinking a beer or drinking a cocktail or drinking whatever it is in the business environment. What can be a game changer? What can be a game changer? What can be a real what is something that can drive in cinemas? That's a good idea. Drive-in cinemas is a good idea. Yes, for the movie industry, that is a definite possible solution. I think there's someone in San Fernando. There's my allergies acting up, guys. It's not coronavirus. There's someone in San Fernando that was actually doing drive-through cinema. I'm not sure if how well it has done, but what else? I want you all to think think about the pandemic, and think about the limitations that we have in the pandemic, and what can be done to now restore little bubbles or small hubs to eat in. That possibly, yeah. You and your friends or your family go in, and say, right, we go in, and we are now in a bubble that is vented properly, meaning the air is now taken out through a vent and sent outside. And the person who's coming in to serve you, they will be fully masked to bring your food. And now you could be in your bubble with your mask off, eating your food and drinking your. So yes, Shakila, yes, yeah, that's fine. But remember, what there'll be some issues with that, right? What will be some of the issues that will be for that? The cost. Maybe we could use plastic, plastic that can actually seal. Yes, possible. We could. But so far, the cost of doing all of these bubbles and screens is it sometimes not as efficient as we'd want it to be. So that's a possibility for some innovation to occur, with some bright minds to come up with a design that might be easily applied to all restaurants. Imagine if Shakila, imagine if you came up with a design that is good, that is workable, that is easy to set up, that is cost effective. Imagine how much money you're going to make, Shakila. because all restaurants all over the world, you can actually now patent your idea. You patent your idea, and get you get a there are no you can get a company to now mass produce. Actually something, that's actually something you could think about. Kavita P, but there are no new movies releasing anyway. Why are we open cinemas? Most production companies are now looking to sell the rights of movies to streaming services. True, true. Yeah, I know. But remember, Kavita P, there would have been persons doing movies before the pandemic that would like to have it released. I mean, they would have already spent that money. So yes, but the selling it to streaming services is yes, to get, because people are staying home and they're watching their movies home. But remember, there's something about cinema that I don't want to use the word and let it out of the bag. And but we spoke about this in community. For those of you who are in community, we do not want to be a commodity. What we want is, can anyone remember what we said last week? We don't want to be a commodity. We don't want to just be, we could buy Panadol anywhere, we could buy Augmentin anywhere, we could buy Chloraseptic anywhere. But what do we want to be? And this is with respect to movies, which is with respect to restaurants. This is with respect to perhaps the airline industry as well. Anything, any type of business venture, you want to move away from being a commodity, but being and becoming an. Maybe there's a hint. I'm using the word "and," so therefore it's a vowel. Yeah. What are we trying? What are we trying to reach to? To empower businesses. This is the answer. My question, or is no, Shakila, to empower? We are no. I'm talking about from the customer experience, right? We don't want we don't want, as a business, you don't want to be seen as a commodity, right? So to the customer, we want the customer to see us as a business, as an, and yes, it's an e-word. It's an e-word. Jahil, I know you're with us. Wanna make a try? I doubt very much you are going to go back and chop it there. No, no. To the customer, you do not want to be seen as a commodity. To the customer, you want the customer to see you as an E. Your product or your service to be an E. Yes, you're an entrepreneur. Yes, fine. You're out here trying to essential. No, no be cash. You all don't remember. I'm disappointed that you all don't remember this. We did this just last week. It was the lecture on branding and marketing, strategic marketing. All right, somebody could answer me, what could be the game changer that I was talking about that can help restore the normal operations of all of these businesses that we're talking that are being threatened to close? So I have two questions out there. What could be the game changer, and also what you want your customers to see you as? Jahil, you're still coasting, right? You're still coasting. Where's that one? What's that about? I thought you'd give me an answer, man. And Jahil, you did well in your Insta, so no need to coast. A cure for COVID, all right. No Vcash, not exchange, not exchange. Nobody? Nobody? Vaccine? Yeah, vaccine is a game changer. But before you can reach the vaccine, before we can reach the vaccine, Samantha, see. Come on, guys. From March of this year to now, it has been discussed actually from as early as May. There were some discussions and some investigations on its application in all over, not only in business but in everywhere. So nobody answered the question. Okay, so I'll answer the question. So a possible game, no Vikash, but thanks for trying. Thanks for trying. Thanks for trying. The game changer that I'm talking about is testing. If we could have had a cheap, quick, and reliable, yes, because that's okay. That's, at least you tried it. If we can have a cheap, quick, and reliable means of testing for coronavirus before you come into a restaurant, all the workers are tested before, all the employees are tested before, and then you can come in and we can be sure that everybody is 99% free. Then we can have back to normal cinemas, back to normal restaurants, back to normal flying. So there were some talks about quick testing, quick methods of testing that can be used, but we haven't reached much further on it globally. And the answer to the question that I asked on what you do not want, what you want your customers to see you as, you don't want them to see you as a commodity, but what you want them to see is, so the answer to the first one is testing. Quick, easy, and reliable. And the answer to the second question is experience. And this ties into why persons, Kavita was mentioning, Kavita P was mentioning that why do people go to movies anymore? They just stay home and stream. But it's the experience that people go for. They like the experience of having to go out, maybe perhaps go out on a date, or just go out with friends and look at a movie together on a huge screen that you wouldn't be able to have and afford at home generally, and to be in a theater that has comfortable seats, that has good sounds, um, good surround sound systems, etc. So it's the experience. So that's why I mentioned these two things for you all. So back to the lecture on the ratios. So this is where your operating cash flow ratio is important. You have to take a look and see if it is you are generating enough cash to meet your commitments. And if that number now starts to get below one, then you're going to be in problem. It essentially means that you're going to be in deficit every month in being able to maintain your operations. And I can speak from experience where, we have had to we've started this enterprise, and we knew that it would have taken some time to get off the ground, but the estimates on the amount that is required to keep it afloat were far more than how much we catered for, and it constantly left us in a negative cash flow position, and we had to make a decision on letting it go, or stopping it, right? So this is an important ratio to look at. The EBIT is your earnings before interest and tax, and you would see, especially when the banks and all of these large organizations are doing their printed financial reports, to talk about net profit before tax, earnings before tax. That's what this is about. And then the EBITDA is your earnings before interest, tax, depreciation, and amortization. All right, so this is essentially your ratios lecture. It's all mathematics, it's all formulae, and it has to do with interpretation based on industry standards. We introducing these ratios to you so that you'd be aware. Um, for exam purposes, for examination purposes, we may just ask for an explanation on one or two key ones that are relevant. So we we just want you all to have an appreciation of what these ratios are, what they mean, some of the more commonly used ones, some of the more relevant ones that would be needed in your management career. All right, so let's go take a break now. And when we come back at 11, we're going to start reviews. We're going to start our reviews. We're going to have an open discussion as well. We can start off with an open discussion on lectures that we've done in the past, on your exam, on your exams coming up, on any topics or issues that are related to management that you may want to have answered. We could have that discussion when we come back at 11. All right? So let's go for the break now and return at 11. Break now.